If you have a low credit score, financial advisors will often offer the same piece of conventional wisdom. Keep your head down, pay your minimums, and let time heal your report. But trying to wait it out while sitting under an avalanche of debt is a mathematical trap. Every month you wait, you pay what the financial industry calls the algorithmic low credit tax. For example, a home buyer with a 620 credit score will pay a higher interest rate than someone with a 760 score. On a standard 30-year mortgage, that gap equals roughly $60,000 in excess interest out of your pocket. That extra $60,000 goes straight to the bottom line of the lending institutions. Credit bureaus, collection agencies, and predatory banks rely on consumers believing that credit repair is a passive waiting game. These institutions use three specific, systemic delay tactics designed to keep your score suppressed and your interest rates high. We are going to break down exactly how these traps function and how you can use federal law to bypass each of them. By understanding these hidden friction points, you stop relying on patience and start forcing the algorithm to reward your data. The first trap is the illusion of convenience. When consumers spot an error on their credit report, a phantom late payment, or a debt that belongs to someone else, the credit bureaus push them toward a fast, easy online dispute portal. What the portal hides is an automated system called eOscar. When you type your explanation and upload your bank statements, eOscar strips away all of your physical evidence and context. This diagram shows what happens next. The system takes your life-altering financial dispute, scans it, and compresses it entirely into a generic 2-digit code. The creditor looks at that single code, clicks a button to verify their own faulty records, and the bureau dismisses your case. If you submit the dispute again online, the software drops you into a frivolous loop, legally ignoring your follow-ups because the algorithm has already rubber-stamped the error. You break this loop by abandoning the web forms entirely. You draft your dispute on paper, attach your physical evidence, and send it via certified mail with a return receipt. Sending a physical letter requires a human being at the bureau to open your mail and manually review your documents. Removing their digital convenience removes their ability to automatically dismiss your claim. The second trap relies on a widespread piece of terrible advice, the idea that carrying a small balance on your credit card helps build your score. In reality, carrying debt incurs interest and artificially inflates your credit utilization ratio, which dictates roughly 30% of your total score. This diagram exposes the timeline disconnect that catches millions of consumers. Notice the multi-week gap between the billing cycle close date and your actual payment due date. Credit card companies report your balance to the bureaus on the closing date. If you wait to pay your bill until the day it is due, the algorithm takes a permanent snapshot of your high balance weeks earlier. Your score is penalized for high utilization, even if you pay the card off in full shortly after. This new chart shows why this is more dangerous today than ever before. Modern scoring models like FICO 10T and VantageScore 4.0 use trended data. They stretch backward to analyze a 24-month historical trend line. A single month of good behavior will not immediately erase a 2-year pattern of maxed-out accounts. The actionable solution is the micropayment strategy. You make multiple small payments throughout the month to push your total balance below 10% of your limit several days before the statement closing date. By ensuring the bank reports a near-zero balance, you dictate exactly what data the bureaus receive. You beat the algorithm at its own mathematical game. The third trap is the illusion of the immediate fix. When consumers finally save up enough money to pay off an account sitting in collections, they expect their credit score to jump the next day. But legacy scoring models, particularly the FICO 8 versions heavily relied upon by mortgage lenders, do not care that you handed over the cash. Take a look at this graph. When you pay a debt collector, the account status flips from unpaid to paid, but the heavy 7-year penalty remains attached to your credit history, keeping your score flatlined. To actually recover those points, you have to bypass the standard payment process. You call the debt collector and negotiate a pay-for-delete agreement, offering to settle the debt only if they promise to completely erase the account from your credit file. Debt collectors will often agree over the phone, take your money, and then refuse to delete the file. You must demand the pay-for-delete agreement in writing before a single cent leaves your bank account. True credit recovery happens when you completely scrub toxic data from the record.
updating a bad mark to paid leaves the damage entirely intact. Inaction is incredibly expensive. Accepting a low score means absorbing tens of thousands of dollars in excess mortgage interest, higher car insurance premiums, and denied apartment applications. But you do not have to ask the bureaus nicely for an accurate score. You can weaponize the Fair Credit Reporting Act, or FCRA. When you draft your physical dispute letter, you use exact legal phrasing. You state, "Under the FCRA, I demand a reasonable reinvestigation and deletion." This invokes an absolute legal mandate. The bank or collection agency has exactly 30 days to produce verified proof of your debt. If they fail to provide that documentation, federal law dictates the bureau must delete the account from your record immediately. Stop waiting for automated systems to take pity on you. Subscribe to the channel, check the links below for our physical dispute letter templates, and legally force the credit bureaus to do their jobs.